I think that when you guys were asking me to think about risks, then that certainly is a risk to the outlook, because one of the things that you notice in the history of oil prices is that there's kind of a nonlinearity, that when economic growth around the world gets high enough, then all of a sudden you jump to a pretty high level. And there's a risk that we're in that nonlinear portion of the curve right now. And if global GDP, doesn't follow the IMF forecast, but rather, recovers quicker, then that could put a lot of upward pressure on oil prices. Now, we've carefully modeled the impact of oil prices on the U.S. economy. And the interesting thing is that the negative effect that used to be a big deal is much less of a big deal, because we're such a big oil producer now. So we get a positive effect from higher oil prices and a negative effect, of course, for higher gas prices and so on. And those two effects, almost cancel now. It's been a really big change.
Have you modeled the effects of higher interest rates on the economy, and at what level do you think it does start to weigh on the GDP growth that you can expect?
We've got a big model with 200-something variables that we follow, and right now, the interest rates that are consistent with our growth forecast are about consistent with the Fed forward guidance and with the CBO's long run forecast.